Welcome to episode 9 of Thick Sustainable Infrastructure Finance, where we challenge conventional wisdom of sustainable financing. I'm Bill Fitzgerald, the Chief Investment Officer of Fitzgerald Asset Management. Today's episode is entitled, Why Bonds? A common question in the world of investing, and particularly in recent years, when equities have been seemingly unstoppable in their rising valuations. So, why? What is the benefit of investing in bonds in today's market and relative to thick, sustainable infrastructure in particular? When investing, one must consider two sides of the coin. One side of the coin is the return on one's investment. The other side of the coin is the risk of that investment. Research of investment outcomes over the years has demonstrated an empirical relationship between these two sides of the coin. Investments with higher expected returns also have higher risk related to their potential outcomes. Based on this proven empirical relationship, Harry Markowitz developed what is known as modern portfolio theory to apply this relationship to combinations of investments in a portfolio of risks to demonstrate that investors can manage their investment risk by constructing portfolios with allocations to multiple asset classes. Now, bonds play a prominent role in the construction of investment portfolios. During a financial disruption, the total return of bonds is consistently significantly higher than equities and other asset classes during these disruptions. The ability to preserve or increase the value of some portion of a portfolio is an important reason to invest in high-quality bonds regardless of yield. Now, let's take a look at 3 disruptions during the last 20 years that serve as examples of why we believe an investor should have a bond allocation. This chart shows the performance of various asset classes during the tech bubble of 2000, the great financial crisis of 2008, and the global pandemic of 2020. This data demonstrates the following about market crises. Number 1, equities performed poorly, often for periods measured in years. Number 2, asset classes used to diversify portfolios, such as high-yield bonds, commodities, and gold, performed inconsistently but generally poorly. And 3, government bonds performed well as investors shifted capital to the safe haven. So our short answer to the question, why bonds, is why not? Investors most certainly should allocate a portion of their assets to bonds to preserve their capital should markets experience an unpredicted but inevitable disruption. Beyond risk management, bonds also provide liquidity for current spending and future liabilities. And historically, bonds increase in value during times of market stress. But don't just take our word for it. Our opinion about the merit of an allocation of bonds is shared across the industry. This is a question being asked with increasing frequency. Most model portfolios continue to recommend a significant allocation of bonds. For example, see these suggested allocations from Fidelity. All except the riskiest of them has an allocation to bonds. Now to the specific. When looking at thick, sustainable infrastructure investments and addressing environmental sustainability, foundational allocations in fixed income generally align well with project timelines as well as risk profiles. As an intergenerational challenge, financing long-term investments in thick, sustainable infrastructure with patient capital is prudent. The rewards, particularly in environmental terms, will compound over time. Bonds serve an important function in risk management, which I'll discuss later. What is most relevant about bonds that finance thick, sustainable infrastructure is these bonds meet our thickness criteria. The projects are immediately scalable. They are repeatable. Their impact is material and measurable. Plus, once in place, they provide continuing benefit for decades, even generations to come. So while the traditional financial reasons for owning bonds are compelling, the environmental sustainability rationale is dramatic. Bonds can accomplish thickness unlike any other financial instrument. Now, we acknowledge the role of other high risk and reward and venture capital investments in addressing our common environmental problems. But their failure rates against investment grade bonds are variable and quoted anywhere from 25% to 75%. Swinging for the fences and very possibly losing time and money on failed efforts could mean exponential losses and setbacks in terms of what is ultimately attainable in this effort. Our thickness assessment process identifies sustainable infrastructure investments with a lower risk profile, placing them neatly on the lower left end of the risk-return graph. As this investment space matures, these bonds complement high-risk reward investments. They are a staple in thick sustainable infrastructure since municipalities and corporations committing to building this infrastructure will be interested in measurable, scalable, material, and reliable results. So there are sound reasons to invest in bonds, both in managing investment risk and in managing environmental risk. Thank you for joining us. Please tell us what you think. We always learn from our colleagues.